I've made all the mistakes possible when trading options. Trust me. And luckily, I learned from my mistakes for the most part. And now it is time to lay out the biggest mistakes that beginners make when trading options. Because, well, mistakes means losing money, and losing money means, I don't know. Comment down below what losing money means. Let's go. Funniest comment wins. Ladies and gentlemen, my name is Pandrea, and welcome back to Pandrea Finance, your favorite finance channel here on YouTube, right? We just passed 30,000 subscribers pretty quickly, so thank you for that. Now on this channel, I take you through my investment journey and teach you how I try to make money in the stock market, the do's and don'ts, and today we are talking in particular about the don'ts. More specifically, the don'ts of option trading. Now I know trading options is very exciting when you first start out, but we need to understand the common and not so common mistakes that people might make so that we can ultimately stop losing money. All of these are very important, so don't skip any. Hit the like button if you're ready to begin, and let's get into it. Not planning your trade. I think this rule applies to life in general, not only when you're trading, and that's not planning ahead. Winging it might work for more unimportant things here and there, but when it comes to important things in our lives, I think that we can all safely say that the majority of successful people make a plan. Option trading is no different, unfortunately. See, options is like a war between the buyer and the seller. Each one makes their plan of attack and how they intend to enter battle. I like this analogy. The spoils rewarded to the ones with the best strategy and possibly a bit of luck, but rarely can you jump into a trade, into battle, and expect to win consistently without having a strategy that favors you. Now, it's obviously important to know the different strategies so that no matter the situation, you will be ready with the right strategy. But you must also take the step of actually writing down your game plan on paper. When do you plan on entering a trade? When do you plan on exiting? When and if will you manage a trade along the way? And stick to your plan. This way you can analyze the trade afterwards and fix the strategy if needed. This will make you a better investor and trader. Trust me. Trading too big. We've all done it before, right? Going all in, betting it all on red. I don't know why I did that. That's dice and the red is. Anyway, now if you've made this mistake, chances are you quickly learned from it and hopefully fixed it. Basically having no choice, but some never learn. Anyway, trading with too big of a percentage of your portfolio on one idea is one of the worst mistakes that anybody can make because you will blow up your account eventually and then you won't have any money left for any further mistakes. Now, I could sit here and easily tell you, hey, only trade with 2% of your portfolio or 5% of your portfolio. That would be enough. But most of you will learn this mistake by making it yourself. And sometimes I guess that's the best way to learn. See, when I started trading options myself, I was told never to risk more than 5% of my account. Now, did I listen? Of course not. Did I learn from my mistake? Yep. And now I am here telling you the same thing. Will you listen? Of course not. But will you eventually learn yourself? I can only hope. Too many positions. Trading is hard enough. Why complicate it with too many positions? As one person, you can only manage so much, especially when it comes to options. You need to make sure that you are not overwhelmed by the amount of positions that you take on so that you can properly give each position the attention that it deserves. Even when building your stock portfolios, I see people try to buy 100 different stocks when all you need really is around 10. This way you can easily keep up to date with your stocks or your trade and not lose track of them. Also, at the end of the day, you can make just as much, if not more money, with fewer concentrated positions than diluting your investments across too many positions. Of course, keeping in mind the previous rule of not trading too big of a portion of your portfolio at one time. So the best solution to this mistake is to not overcomplicate things. Scale back, take it easy so that your investments are manageable and therefore more likely to be successful. Got it? Good. Buying weekly options. I understand the appeal of trying to double your money or triple your money overnight. I get it, trust me. But I also understand the appeal of not losing all your money too. The one important thing that we must start to realize sooner rather than later is that there is a difference between investing and gambling. The unfortunate truth is a lot of people don't have the patience to invest, so they turn to gambling and speculation. And one of the most popular forms of speculation, especially in today's day, is buying weekly options. Now combine this with our previous two mistakes and you've hit the trifecta of things not to do. Now there is a simple fix to this, and that is if you are going to buy options, start moving that expiration date a little bit further out. Go 1 month out, and then you might realize that even a month might be too short. Oh, a month passed already? So you go 3 months out, 6 months out. This doesn't mean that you have to hold it until expiration, but it will mean that your trade will have time to grow and hopefully make you some money. But more importantly, your option will lose less value in that contract when you go further out because the theta decay will be less significant. You gotta know your Greeks for that, right? So check out this video all on the Greeks and understanding them. For me, if I buy options, I would buy with an expiration date of at least 1 year, if not 2 years out. These options are called leaps, and I did a whole separate video on them, which then if you want to check that video out, you can click here. No liquidity. Woo! This one stings. You get into a trade, and when it comes time to sell, you realize that you got nobody to sell to. When I was first learning about options and messing around with some low volume calls. Good job, Alex. Now let's take a step back. Any trade or investment has two sides, the buyer and the seller. The buyer buys from the seller and the seller sells to the buyer. Now this should sound very obvious, but you would be surprised at how many beginners overlook the fact that when they want to sell something, there needs to be a buyer. So how do we make sure that we don't end up in this situation? Well, let's pull up the option chain and take a look. Now, when taking a look at a stock, you can see that the liquidity is tied to the volume that you see when scrolling down and looking up volume. So in this case, Roblox has a volume of 10.33 million shares that are traded on any given day. So it would be safe to say that if you were just buying and selling this stock, you would not have a problem buying or selling it because the liquidity is there. But now if you want to take a look at options, we go trade options, and let's scroll out all the way to January 20th, 2023. Let's say I want to buy call options on Roblox, so I go out to the $165 call, which is trading at $12.43. And now you can see the bid-ask spread. Now, the first indication that maybe the liquidity is not there is that the bid price and the ask price are too far apart. That means the buyers and the sellers are too far apart and it's hard to meet in the middle. I want to buy something for cheap, somebody wants to sell it for too much, and the transaction is just not there between buyer and seller. Digging in deeper, if we click on the bid-ask spread, a bunch of information will pop up and you see their volume and open interest. Now, obviously, the higher the volume and the higher the open interest, the more liquidity there is in that option. In this case, you have a volume of 0. That means 0 contracts of this particular call option were traded. An open interest of 34, that means 34 open contracts are out there, buyers and sellers. So you want to take a look at these two to see the liquidity of that particular option, and you don't want something with a low volume and especially low open interest, because one, even if you do manage to buy, then there might not be any interest when you try to sell. Now you'll see this really relevant in options that have a really far out expiration date, and especially ones that are not close to at the money. So either all the way out of the money or all the way in the money might have very low open interest and volume. So something to keep in mind, make sure liquidity is good to go, and you'll be good to go. Keeping losers and selling winners. There is an overwhelming trend in the stock market to do the opposite of what you're supposed to do. You ever realize that? You would think that buy low, sell high would be something easy to follow. But no, you see it all the time. They buy into the hype at the top and then they panic sell when the prices fall. These emotional decisions will also affect you when trading options. More specifically in managing your trades. This is by far the best tip that I ever learned over the last years of trading options myself, and that is to let your winners ride and cut your losses short. I would never have grown my trading portfolio to where it is now if I did not correct this specific mistake of selling too soon when I'm in the profit, or when I'm on the losing side of a trade, I wait and I hope that it'll recover and go back to at least what I put in. Now, I know this might seem counterintuitive at first, and I know emotions will probably get the best of you. This is why this is a learning experience, so take it easy. For example, I already know if you're on a losing side of the trade, you convince yourself that it'll recover, when the best thing that you can do is to set a limit of how much you're willing to lose, and that if that's hit, then you just cut your losses short, take that loss and move on to the next trade. Whenever I don't do this, I end up losing even more. Now, on the other side of the trade, when you're in a winning trade, you might sell way too early. Countless times, I myself sold a trade that could have made me 100% or 200% return, but I closed it out at 15%, 20%. Now, of course, profit is profit, and it will really depend on your own risk tolerance and your goals. But for the most part, we all are here to try to make the most amount of money possible. And a step towards that goal is to let your winners ride, cut your losses short, and move on. Not being consistent. When you find something that works, you have to stick to that for as long as possible. Too often I see investors and traders all over the place with their investing. Maybe you've experienced this yourself. One week you want to buy calls, and then the next week you're like, you know what, I think I'm gonna sell puts. If you are not consistent with your strategy, your gains will be just as big of a mess. And at the end of the day, you're going to look at your portfolio and wonder, what went wrong? Now, I can't tell you what will work for you, but for me, I have found that selling options on a month-to-month basis is the most reliable and consistent way to make money with options. Now, the reason that I love selling options as opposed to buying them and throwing my money away is because the percentages are in your favor when you are the seller. You can very confidently make a percentage return on your portfolio each week or each month just by sticking to one consistent strategy. In my case, it's selling options. And you do that over and over and over again. This has been my key to making passive income for my long-term stock portfolio, and it will take the gambling aspects and erratic behavior out of option trading. Be consistent with something that works, and you will be successful. Not understanding implied volatility. This is one of the most important things that you need to understand when it comes to option trading. You must understand implied volatility and how it affects option prices. This is the key, in my opinion, to profit. If you understand implied volatility, you can make money with options. It's that simple. When implied volatility is high, the option premium prices are high. This is important to know because when buying options, you are risking buying very expensive options. Now, when implied volatility decreases, well, that in turn causes the option prices to decrease as well. So what happens when you buy a call and the IV is high and then the IV goes down? Your option will go down and you will lose money on that premium. This is a very common thing, especially around things like earnings. Now, you might have heard of the term IV crush. Well, this is because IV is very high in anticipation and demand for big moves around the time of earnings, and then when that IV contracts, the option prices take a nosedive along with it. This, on the other hand, is great for when you're selling options. When selling options, we want to sell at the highest possible amount to collect the most amount of premium. So if I were to sell options when IV is high, you will collect more premium. And if IV goes down, then that option will lose value, which is exactly what you want when you're selling options. And this is how you make money, and this is how you profit and succeed in option trading. Not tracking your trades. If you are serious about investing, trading, learning options, do yourselves a big favor and invest first in a notebook. Look at that one, that's a fancy one. Notebooks will help you out immensely when it comes to all the rules that I mentioned in this video, by not only helping you follow them, but by spotting mistakes that you might make along the way and you don't even know you're making them. Maybe you don't realize you're trading too many positions or not being as consistent as possible until you put it down on paper and review. Now, my personal preference is to physically write them down instead of maybe a spreadsheet on the computer or using something on your phone. I write down my plans for the month and the trades that I enter, my exit strategy, and keep track of them on one page. After exiting my position, I can then review the trade and see more clearly what I did right, what I did wrong, what I could have done better, and only after I close my position, then I would suggest maybe transferring all the data from your notebook to a spreadsheet just to keep track of everything there for sort of long term. But for me, it's important to have that notebook and maybe a nice little pen to go along with it. To track my trades. Question of the day today is, what are some of the mistakes that you've made when investing and trading? Leave your comments down below because this is how we all learn. Or if there's something that has worked for you, sort of a mistake fix, comment that down below as well. I love reading the comments. I do read the comments, and I love when dialogues start down in the comments below. minus the scammers pretending to be me with WhatsApp that I do not have, so just ignore all of those. Now, of course, all of this is not financial advice, so don't listen to a random guy like me on YouTube telling you what to do and what not to do. Do your own research, study, and learn as much as you can, and I have confidence that you will be successful in everything that you want to do. Check out the links below in the description for all the videos related to things that I spoke about in this video. And other than that, thank you so much for watching, and we'll see you on the next video.